You know, we've been hearing from a lot of you about some fascinating material from Tom Basso, specifically around trading and this whole concept of position sizing.
Right.
So for this deep dive, that's exactly what we're going to unpack.
Okay.
Our mission today is to really pull out the most crucial insights from Basso's work on just how much of a trade to actually take on. You can think of this as your shortcut to getting really well informed about this absolutely vital part of trading.
Absolutely. And Tom Basso, for those who might not immediately recognize that name, is a real veteran in this game.
Yeah.
He's the legendary Mr. Serenity from Market Wizards.
Oh, yeah.
Someone with decades of hands-on experience managing serious money.
Yeah.
What's so valuable, I think, for our listeners is that his perspective is rooted in practical application, not just academic theory. He's also the author of books like Panic-Proof Investing, The Easiest Stroke in Golf, and runs a great website, enjoytheride.world, where he shares a lot of his wisdom.
Exactly. And, you know, at the heart of it, Basso tackles a question that maybe doesn't sound as exciting as picking the next big winner. But it's arguably way more critical. It's not just what to trade, but how much to trade.
Right.
It's that how much that can really make or break you, especially when you're starting out.
What's fascinating here is that Basso lays out this foundational framework for trading success that goes beyond just finding those winning trades. He talks about 3 key requirements.
Okay, let's unpack this. What are those 3?
Well, the first is what he calls the buy-sell engine. That's your strategy for deciding when to get in and out of a trade.
Gotcha.
The second is managing the position and the overall portfolio.
Right.
And the third, crucially, is the mental side of trading, your discipline and psychology.
Yeah, it feels like most beginners really obsess over that first part, the buy-sell engine, trying to find some magic indicator.
That's precisely Basso's point.
Okay.
While having a good entry and exit strategy is important, he argues that managing your positions and your mental state are actually the more significant factors for long-term success. Here's where it gets really interesting.
Okay.
He even shares this anecdote about how he once created a completely random buy-sell engine.
Random.
Literally a computerized coin flip.
Wow.
And when he paired that with his robust position sizing techniques, applied across diversified liquid futures markets with logical stop losses, over years of data, it surprisingly showed a slight tendency towards profit.
Wow. That really drives home the power of managing your position size, doesn't it?
Yeah, it does.
So the crucial insight here for our listeners is that mastering how much you trade can be more impactful than obsessing over what you trade. So for this deep dive, it sounds like we're going to be focusing primarily on that second requirement.
Yes.
Managing position size.
Exactly, because as Basso emphasizes, this is where so many traders, both new and experienced, can stumble.
So let's get into the why. Why is controlling your position size so absolutely critical?
Well, the most fundamental reason boils down to something called risk of ruin.
Okay.
If you consistently take on oversized positions, a string of losses, which is inevitable in trading, can decimate your account to the point where you're simply out of the game.
Wow.
You no longer have the capital to make the next trade.
That's a scary thought, like getting knocked out before you even have a chance to learn and improve.
Precisely. But it's not just about avoiding total loss.
Okay.
Improper position sizing also has a significant impact on your discipline. If your positions are too large. The emotional roller coaster of seeing your account swing wildly up and down can lead to impulsive, emotional trading decisions.
Okay.
You might exit winning trades too early out of fear. Or hold on to losing trades for too long, hoping they'll turn around.
I can definitely see that the stress alone would be overwhelming.
Yeah.
Now, what about the other end of the spectrum?
Yeah.
Sizing positions too small?
Basso points out that sizing too small can lead to disinterest and boredom.
Really?
If your potential profits are so minimal, it's easy to become sloppy or lose focus. And ultimately, your returns will suffer. And let's not forget the basic math of trading. Profit equals the difference between your sell price and your buy price, multiplied by your position size. It's illogical to focus intensely on the first part, where to buy and sell, and completely ignore the second, how much.
Okay, so we understand the why. Now let's dive into the how.
Okay.
How do we actually control our initial position size?
Well, Basso's thinking here is heavily influenced by the legendary trader Larry Hype, who famously said, never risk more than 1% of your total equity on any trade.
1%? That sounds surprisingly small.
Yeah.
To someone just starting out and eager to see big returns?
It might, but the goal is longevity and consistency.
Okay.
Basso explains that the risk per trade is simply the difference between your entry price and your stop-loss price. Now, this is a crucial point.
Okay.
Basso advocates for setting your stop-loss based on logical market action. Those levels of supply and demand before you even think about determining your position size based on your risk tolerance.
So find a logical point to exit if the trade goes against you.
Exactly.
Based on where the market tells you that point is.
Based on the market.
Got it.
Exactly.
Okay.
Once you've established that risk per unit, whether it's per share for a stock or per contract for futures, you can then use a formula to calculate your appropriate position size.
Okay.
Account equity times % risk allocation per trade divided by the risk per unit.
Okay, let's break that down. What's this risk allocation percentage?
That's the percentage of your total account equity you're willing to risk on a single trade.
Gotcha.
Basso emphasizes that this is a very personal decision.
Okay.
He offers some starting points for complete novices. He suggests no more than 0.5%.
Okay.
If you have some experience and are trading medium to longer term, around 1% might be appropriate.
Okay.
And only if you have a high risk tolerance.
Right.
Lots of discipline and experience.
Yeah.
Should you consider going up to 2%?
Okay.
He cautions that if you have, say, 20 positions and you're risking 2% on each, a scenario where they all hit their stops would result in a significant 40% drawdown, which most people would find very difficult to stomach.
Those numbers really put things into perspective.
Yeah. For me, and I'm sure for our listeners. Yeah. So let's run through an example to make this concrete.
Sure. Okay. Let's say you have $100,000 in your trading account.
Okay.
And you decide to allocate 1% risk per trade. You want to buy XYZ stock at $20.50.
Okay.
And you set your stop loss at $19 or $5. That means your risk per share is $1.45.
Okay.
Using the formula, $100,000 times 0.01 divided by $1.45 gives you approximately 689.66 shares.
Right.
Since you can't trade fractions of shares, you'd round down to 689 shares.
Got it. And what about futures?
Sure.
How does that calculation differ?
The core principle is the same.
Okay.
But you need to account for the contract size and the per point value.
Right.
Let's take gold futures as an example.
Okay.
So you have the same $100,000 equity, a 1% risk allocation, and you want to buy at $1,275 with a stop at $1,267.50. The risk per contract is $7.50 per point.
Okay.
And in gold futures, each full point move is worth $100.
So your total risk per contract is $7.50 times $100 or $750.
Got it.
Plugging that into the formula, $100,000 times 0.01 divided by $750 gives you approximately 1.33 contracts.
Right.
Which you would round down to one contract.
Okay. Those examples really clarify the mechanics for me.
Good.
Now, Basso also looked at simulations.
He did.
Based on different risk allocation percentages, right?
Right.
What were the key takeaways from those?
Yes, he ran simulations for both stocks and futures.
Okay.
For stocks.
Yeah.
He compared a base case of trading a fixed number of shares to various risk allocation percentages.
Okay.
From 0.5% to 1%.
Right.
Unsurprisingly.
Yeah.
Higher risk allocations generally led to higher overall returns.
Makes sense.
However, what was striking is that the 0.5% risk allocation actually showed better return-to-risk ratios, a smaller maximum drawdown, and a shorter longest drawdown.
Interesting.
Compared to even the base case, it improved the returns and made the strategy psychologically easier to trade.
Wow.
Think of the return-to-risk ratio. Yeah. How much reward you're getting for the amount of risk you're taking.
Right.
A higher ratio is generally better, meaning you're being compensated well for the risk you're taking.
That's fascinating. Sometimes less is indeed more.
Yeah.
What about the futures simulations?
Similar trends emerged. As risk allocation increased from 0.4% to 1%. The overall returns went up.
Right.
but so did the maximum drawdowns and the time spent in those drawdowns.
Okay.
The return-to-risk ratios peaked at a certain allocation level
Right.
and then started to decline.
Interesting.
Basso highlighted the 0.5% risk allocation as a comfortable choice, offering a tolerable drawdown and reasonable return to risk.
Okay.
The simulations really underscored the dangers of excessive risk allocation.
Yeah.
The Blinkist version of those simulations would be, don't blindly chase high returns with bigger size.
Right.
Often a more moderate approach gives you better long-term stability and even better risk-adjusted results.
So risk is one way to control that initial position size.
Right.
What's the second method Basso discusses?
The second approach focuses on controlling the volatility of your initial position.
Right.
Basso shares a personal story about a silver trade where despite having a well-defined stop loss, the extreme volatility of the market caused him significant emotional stress.
Oh, wow.
Even though the trade was initially very profitable.
Interesting.
He realized that volatility itself, beyond just the defined risk, needed to be considered.
That makes perfect sense. Those huge swings can really mess with your head and lead to bad decisions.
Yep.
So how does Basso measure volatility in a way that's practical?
He prefers using the average true range, or ATR.
ATR, okay.
Essentially, ATR gives you a sense of how much a price typically moves in a given period.
Okay.
Basso likes a 21-day measure.
Okay.
But the key is understanding.
Yeah.
It's a volatility gauge.
Got it.
It's a relatively simple way to measure the typical price movement of an instrument over a period.
Yeah.
And it can be applied consistently across different asset classes, like stocks and futures.
Can you briefly explain how ATR is calculated for those who might be curious?
Certainly, the true range for a given day is the widest range between the day's high, the day's low, and the previous day's close.
Okay.
You take the maximum of today's high minus today's low, today's high minus yesterday's close, and yesterday's close minus today's low.
Okay.
The ATR is simply the average of these true range values over a specific period.
Right.
Basso mentions using a 21-day exponential moving average, or EMA, for convenience.
Okay.
But notes that you could use other averaging methods and different time frames, depending on your trading style.
Yeah.
The detailed calculation can be found in Basso's work, if you'd like to delve deeper.
Okay, so ATR gives us a measure of how much the price typically moves.
Yes.
How do we use that to size our positions?
The formula is quite similar to the risk-based sizing.
Okay.
Account equity times percent volatility allocation per trade, divided by the ATR value per unit.
Okay.
Just like with risk allocation.
Right.
The volatility allocation percentage is a personal choice.
Right.
Basso suggests starting around 0.5% for newer traders.
Okay.
And perhaps 0.75% for more experienced ones.
I gotcha.
He, again, cautions against overly aggressive allocations.
Right.
As even on a diversified portfolio, a high volatility day could lead to very large portfolio swings.
Let's run through those examples again, using volatility this time.
Right. For XYZ stock, with $100,000 equity and a 0.75% volatility allocation, if the 21-day ATR is $0.85, the calculation would be $100,000 times 0.00075 divided by $85, resulting in approximately 882 shares. For gold futures with the same $100,000 equity and 0.75% allocation, if the ATR is $3.60 per contract, which translates to $360 in dollar terms. The calculation is $100,000 times 0.0075 divided by $360, giving you about 2 contracts.
And again, Basso looked at simulations.
He did.
Using different volatility allocation percentages for stocks and futures?
Yes, he did.
Okay.
For stocks, he found that a 0.6% volatility allocation seemed to improve returns and return-to-risk ratios compared to the base case. And slightly outperformed even the 5% equity allocation case.
Interesting.
Above that level, the drawdowns started to worsen. For futures, a 0.5% volatility allocation appeared to strike a good balance, offering better returns than the base case with a manageable drawdown and improved return to risk.
So we've covered risk and volatility as ways to control that initial position size. What's the third method Basso uses?
The third approach considers the capital or margin required for the position, even if a trade appears to have low risk and low volatility. And your calculations based on those factors suggest a large position size. The margin requirements could still overextend your capital, potentially leading to margin calls if the market moves unexpectedly.
Yeah, that makes sense. You don't want to tie up so much of your capital in one trade.
Exactly.
That you can't take advantage of other opportunities. Or withstand unexpected margin increases.
Exactly. The formula here is account equity times % margin allocation per trade. Divided by the margin per unit. Basso suggests a simple example of using a 5% margin allocation for our XYZ stock example with a $100,000 equity. 5% allocated to margin and a price of $20.50 per share. The calculation would be $100,000 times 0.05 divided by $20.50, resulting in approximately 243 shares for gold futures with the same equity and 5% margin allocation and a margin of, say, $3,400 per contract. The calculation is $100,000 times 0.05 divided by $3,400, giving you about one contract.
Okay, so we have 3 different ways to calculate your initial position size. Based on risk, based on volatility, and based on margin.
Correct.
Now, which one should you actually use?
Basso argues that using all 3 methods together provides the most robust approach.
Interesting.
Market conditions are constantly changing, with periods of high and low risk, volatility, and margin requirements. By considering all 3, you're getting a more comprehensive picture of the appropriate size for your trades.
That sounds logical. So do you average them out or pick the middle one?
No.
What's the best approach?
Basso recommends taking the smallest. Position size calculated by the 3 methods. This is the most conservative and prudent approach, ensuring you're not overexposed in any one area. In our XYZ stock example, we calculated 689 shares based on risk, 882 based on volatility, and 243 based on margin. The smallest of these is 243. So that would be the recommended initial position size.
Makes sense.
For gold futures, we got 1 contract for risk, 2 for volatility, and 1 for margin. So the smallest is 1 contract.
That makes a lot of sense. Always erring on the side of caution.
Especially
when you're initiating a new trade.
Yes.
Basso also touched on combining risk and volatility in simulations,
Yes. While his software couldn't simulate combining risk and volatility allocation for stocks, he did run those simulations for futures and found them to be beneficial.
Interesting.
Typically, combining these 2 approaches help to reduce drawdowns and improve the return-to-risk ratios.
Now let's shift gears slightly. Basso briefly mentions different forms of equity in your portfolio.
Yes.
What are those, and what does he recommend you focus on?
He touches on concepts like core equity, which subtracts potential losses from new positions, and reduced total equity, which adds back profits locked in by moving stop losses. However, Basso strongly recommends using simple total equity. The total capital your broker shows in your account. He argues it's the easiest, most straightforward, and readily available figure, while it might be seen as the most aggressive of the 3. He points out that you can always adjust your risk, volatility, and margin allocation percentages to be more conservative if needed. Keep it simple is his mantra here.
That definitely resonates. Simplicity often wins in the long run.
Yeah.
Now, what about those just starting out?
Yeah.
With smaller accounts,
yes,
they often find that using these percentages leads to fractional or even zero position sizes.
Right.
What's Basso's advice for them?
He acknowledges this is a common challenge.
Yeah.
And the most sensible long-term solution is to increase your trading capital.
Okay.
He even suggests that aspiring full-time traders should prioritize saving and building their account equity.
Right.
However, for those stuck with smaller accounts, he offers some practical workarounds.
Okay, what are those?
For stocks, he suggests focusing on lower-priced stocks.
Okay.
Which allows you to trade a reasonable number of shares.
Right.
While still controlling your position size in the futures market.
Yeah.
He recommends looking at the smaller contract sizes.
Okay.
Things like micro or mini contracts.
Right.
Which have lower margin requirements.
Yeah.
He even includes a table of various futures contracts and their margin levels in his book as a resource.
What?
Another idea he offers is shortening your trading time frame.
Okay.
which can often lead to smaller risk levels per trade,
Right.
allowing you to still trade at least one contract.
Yeah.
Or a reasonable number of shares.
Those are some really helpful tips for traders with smaller capital. Now, we spent a lot of time talking about sizing that initial position.
Yeah.
But as Basso points out, the work doesn't stop there, does it?
It does not.
What about managing your positions once you're actually in a trade?
Absolutely. Once you're in a position, the risk, volatility, and even margin requirements can change.
Right.
So Basso discusses ongoing position management, which is vital for your success.
Let's start with ongoing position risk.
Okay.
How should we be thinking about that?
Basso explains that as a winning trade moves in your favor, the actual risk relative to your entry point decreases.
Okay.
But the potential impact of a reversal on your growing profits increases.
Right.
Therefore, he suggests setting a higher ongoing risk allocation limit than your initial limit.
Okay.
For example, if you started with a 1% initial risk allocation, you might allow the risk on a winning trade to grow to, say, 2.5% of your equity before you reduce your position size to bring it back down.
Gotcha.
This allows your winners to run,
but
prevents any single position from becoming too dominant in your portfolio.
Okay.
His futures simulations on ongoing risk limits showed the potential for improved returns and risk metrics by employing this strategy.
That's an interesting way to let your winners breathe while still maintaining control.
Exactly.
What about ongoing position volatility?
Basso draws an analogy to the stock market cycle, noting that volatility often tends to increase as trends strengthen.
Interesting.
Just like with initial sizing.
Right.
You need to control the volatility of your ongoing positions to avoid excessive portfolio swings and the emotional trading that can result. He suggests setting an ongoing volatility limit. That's slightly higher than your initial limit, perhaps starting at 0.5%. And allowing it to go up to 0.6% or 0.8%.
Gotcha.
Again, his future simulations supported this idea, showing the potential for better returns and reduced drawdowns with ongoing volatility limits.
So it seems like the principle of setting limits and adjusting position size accordingly applies both at the beginning of a trade and throughout its duration.
Absolutely.
Does Basso recommend combining these ongoing risk and volatility limits?
He does. He believes that using both simultaneously provides a more comprehensive approach to managing your positions, leading to smoother overall performance.
And his futures simulations that combine ongoing risk and volatility limits seem to support this, highlighting potentially optimal combinations that offered improved risk-adjusted returns.
Exactly.
Now, zooming out a bit. Basso also talks about managing total portfolio risk.
Yes.
What does that entail?
This involved setting a limit on the total risk exposure across all the positions in your portfolio. Basso shares his experience of using this concept to inform decisions about adding or reducing capital in his fund.
Gotcha.
When the total portfolio risk reached high levels, it often preceded a drawdown. Host speaker.